Hello students, welcome to the lecture. Today we are going to start with the topic time value of money. So, to begin with, what do you mean by this word, that is time value of money? It simply means the value of, for example, 100 rupees today, that is in 2021 year. What will be the value of this 100 rupees in, let's say, after 5 years, in the year 2026? What will be this value? So that will be calculated as per, by considering the rate of inflation, or you can say rate of interest. So for example, let's say for make it easy, just take it for 1 year. After 1 year, what will be the value of this 100 rupees? Definitely it will be less than 100 rupees. Now to explain you this in a better way, suppose in 100 rupees today I can buy suppose 5 eggs of 20 rupees each. But after a year, the price of one egg, let's say, become 25 rupees, and now with this 100 rupees, I can purchase only 4 eggs. So this reduction of your purchasing power is basically the reduction of this 100 rupees. So, let's say rate of inflation is 10%. So, the value of this 100 rupees will be reduced to 90 rupees. That is 10% of 100 rupees. That is rupees 10. So, after 1 year, the 90 rupees will become equivalent to 100 rupees. Now, if I am an investor, I want to make this 100 rupees either of the same value or of the increasing of the value more than the present value of this figure. So basically, if I have 100 rupees today and I am getting, let's say, 110 rupees after 1 year, if I invest this 100 rupees today and I get 110 rupees after 1 year, okay, and the rate of inflation is 10%, so will I get any benefit out of it? Answer is no. But the only thing is that I will not be affected with the inflation rate. So basically, my investment strategy should be like that the rate of interest on the investment should be more than the rate of inflation. So that's why we are studying this time value of money. Okay? More than. Okay, it should be more than the rate of inflation. So at least suppose it is 12% and this is 10%. So obviously you are in a profitable position that you are getting at least more than what the inflation rate is, because after 1 year due to inflation, the value of 110 rupees will be equivalent to the value of 100 rupees that we have as on today. Okay, so to judge this, to basically to overcome this, we have different things. So the thing that we have, first of all, we have simple interest, then we have compound interest, then we will be going to study future value of the present investment. If you are giving your EMIs, annual installment like LIC premium, that is called as annuity. We're going to discuss all these things in detail. So future value of that annuity, what will be that? Okay, and suppose if you need a sum of suppose 25 lakh after a period of 5 years for some purpose, for suppose for your education of your children, then what amount you need to invest today to find that out will also going to find out the present value of this particular amount. Okay, these all concepts we are going to discuss in this chapter one by one. We'll be discussing the different questions, practicing all those things. Okay, so without wasting any further time, we'll start with simple interest concept. Okay, before moving towards simple interest, let us write something about time value of money. So, according to time value of money, the value of money declines with the passage of time. Okay, and the reason is it is due to inflation. Okay, so let us note down one example. Reason for. Now, why we demand interest either when we take loan or we do the investment? Everyone wants the interest because at the year 0, that is at the present year, the value of 1000 rupees, if your interest is 10%, inflation is 10%, it will be 1100 rupees at the end of the year. So the two reasons that we want interest is first, rate of inflation, and if you do any kind of investment, it involves risk. So the risk premium is also charged. It will depend on the level of risk involved. For example, if I do the investment in FD, I'll get a less rate of interest. Okay, but if I invest in the debt market or equity market, then I'll get the more return of investment. Why? Because this is less risky and these are more risky. Okay, so basically this is the reason. This is how the interests are calculated, by considering the rate of inflation and by considering the risk, level of risk involved in that investment. Okay. Now, let us see the theory. It says, the time value of money, the basic concept in finance is time value of money, which means that 1 rupee today is not equal to 1 rupee tomorrow, other things being equal. So basically, the value of rupees 1 today will be lesser than 1 rupees after 1 year. Okay, and time value of money means worth of a rupee received today will be different from the worth of the rupee received in the future. And preference for money now, okay, as compared to the future money is known as time preference of money. Okay, and when the individual or business institution borrow money from others for certain time period, that's why they give the interest because they will pay some extra money other than the borrowed amount, that is called as interest, and that extra money will cover the rate of inflation plus the risk premium involved that we had discussed. So that will be considering the time value. So what is actually the time value is basically the interest. Okay, and the money being borrowed is called as principal, and additional sum of money for using that money, basically the additional interest or the additional amount that is being charged on that money is called as interest. So such interest is usually calculated in the percentage manner, and the interest paid for use of ₹100 is called as rate percent. What do you mean by rate percent? Suppose 1% interest, that is 1 by 100. So for every ₹100, you are going to get ₹1 extra as the interest. Okay. So the sum of the principal and interest collectively called as amount. Now we'll start with simple interest. The formula of simple interest is very simple, that is P into R into T upon 100. P is your principal, R is your rate of interest, T is the time for which the loan is taken or for which the interest is calculated. So basically, for example, let us take an example. What do you mean by the term principal? First of all, that is Mr. X has taken loan from SBI of 1 lakh rupees. So this loan amount is the principal amount. The rate of interest charged is 10%, okay, and the period for which this loan is taken is 5 years. So put it in the formula P into R into T by 100. Principal is 1 lakh into 10 into 5 by 100. $50,000 is the simple interest, that is the amount that you will going to give by the end of the 5 years will be 1 lakh plus 50,000, that is 1,50,000 rupees. So the amount that you have taken as a loan is 1 lakh, but what you are going to repay to SBI is 1,50,000. Okay. And what do you mean by this simple interest? In this, what happened? The yearly interest is basically, suppose I do the investment in a bank on FD for the same example, 1 lakh rupees, interest rate 10% for 5 years. So I'll be getting that customer Mr. X will be getting yearly interest on that amount. So yearly, simply dividing 50,000, that is your simple interest, divide by 5, that is 10,000. So he'll be receiving this 10,000 interest per annum, interest as an interest income. And only 1 lakh rupees is basically invested in your account. Okay. Now we have another term called as compound interest. Why I'm explaining this? Because there is a basic difference between these two. In simple interest, what is happening? You are receiving interest every year. But in compound interest, suppose for the year 1, you have basically invested 1 lakh. For the year 1, the interest you have received is 10,000. And this interest will again reinvested in this figure. So it will become 1,10,000 now. Okay. And now this will become your principal, and in the next year the interest will be calculated on this amount, and the interest on 1,10,000 for 10% will be 11,000, and then in next year, in second year, this will be added to your principal, so it will become 1,21,000, and by the end of third year, again you will be getting an interest of this amount, but it will not be given to you, it will be reinvested, and now this amount will become 1,21,000 plus 12,100, that is 1,33,100. So now your principal will become this amount. So this thing will goes on till the year 5. Okay, that is for the period for which you have invested in your fixed deposit or in any manner. So this is what compound interest means, and simple interest means you are receiving interest every year. So this is the basic difference. Okay, now let us see some examples for simple interest before moving forward. Okay, let us see first example. This is question number 2 that we have. Okay, so the principal is 10,000. Okay, it says if you invest rupees 10,000 in the bank at simple interest of 9% per annum, and what will be the amount at the end of 3 years? Let us calculate this. So, one second. Okay, principal is 10,000, interest 9%, and time principal 10,000, interest, or you can say R 10%, and time is 3 years. Let me check I have noted correctly or not. Yeah, and simple interest is 9%. Now, the thing that we need to find out, you need to understand, we don't need to find out simple interest. We need to find out the amount. And what do you mean by amount is the principal plus simple interest. So, for this, you need to calculate simple interest. And the formula of this is P into R into T by 100. So, please note down first of all both the formulas and note it like this. Given that, okay, and herein P is principal, R is rate of interest, T is time period, okay, and these are the formulas. So first of all, write step by step, okay. Then solution. Simple interest is equal to P into R into T upon 100. Step 1, to find out simple interest. Principal is 10,000, interest is 9%, time is 3 years upon 100. We have calci, but it's not required here. We can use that. 9 3s are 27. It will be 2,700 rupees. Okay. Simple interest. Now step 2. To calculate amount at the end of 3 years. Principal plus simple interest. Okay, so it will be 10,000 plus 2,700, that is 12, one second. 12,700 rupees. Okay, you have to write like this your answer. Okay, done. Now, question number 3. 2,000 rupees is deposited in a bank for 2 years at a simple interest of 6%. What will be the balance at the end of 2 years? Now, the manner in which we have to write the answer, I have told you right now. I'll just show that to you, both the screen first of all. So you can pause it and note it. In this manner, you have to write the answer in your examination. But from now, I'm going to calculate fastly. Okay, because we have to cover the entire syllabus. Okay, so I cannot help you, or I cannot dictate you each and every question in the same manner, but I'll be telling you how to solve them. Okay, so you can note this down, and now we'll be solving the question, next question, the question we have read just now directly. Okay, done? Okay, question number 2. So the amount that was there is 2,000 rupees, 2 years and 6%. 2,000 rupees, simple interest R is 6%, time is 2 years. Cross check once again, okay? Because if you make any mistake, whole your answer, whole your time will get wasted. Okay, now let's solve it. First of all, calculate simple interest. We need to find out the amount, okay, and simple interest. So first of all, calculate simple interest. P into R into T by 100. So it will be 2,000 into 6 into 2 divided by 100. That will be 240 rupees. Okay. Now, this is the first step. Now, second step, the amount is equal to principal plus simple interest, that is 2,000 plus 240 rupees. So, it will be 2240 rupees. Okay. Now, this is your answer. Pause it and note it. Now, next question. Find the rate of interest if the amount owed after 6 months, okay, is 1050. The borrowed amount is 1,000. So, what they have given? They have given the time, they have given the amount, they have given the principal. We need to find out the rate of interest. Pause it and note this, okay? Okay. Find rate of interest. Time is 6 by 12, that is 6 months. You can say 1 by 2. Okay. Amount is 1050. And principal is 1,000. So first, let us see what will be the simple interest. Simple interest will be amount minus principal. I have derived from this formula. We have amount, we have principal, we don't have simple interest. So, simple interest is amount minus principal. So, that will be 1050 minus 1,000. That is 50 rupees. This is your simple interest, right? Now, simple interest, we know it's 50 rupees. Then we have the formula. We need to find the rate of interest, okay? So simple interest we have 50, principal we have 1000, time we have 1/2, and we have rate of interest. Okay, so it will be 50 is equal to 5R, R is equal to 10%. So this is your rate of interest, okay? Now you can cross check all the answers, okay? 10% right. Two two four zero is okay. 12,700. Now, let us start with another concept, compound. First, I'll like to read the theory for this. Okay, so this is another method for calculating interest. The concept I had already explained. Okay, in this method, we have already discussed that the interest earned by an investment will be reinvested so that it will also earn interest. Okay, so we have already discussed that interest will be added to the principal, and that change principal, that is principal plus interest, will become the principal for the subsequent year. Okay, and hence once again you will get the interest on that interest. So suppose 100 rupees is invested at the rate of 6% to be compounded annually. At the end of the first year, the value of the investment will become 106 rupees. Okay. And now this 106 rupees will become the principal for the second year. Now the formula that we have for compound interest, you can note it, is amount is equal to P, that is principal, bracket 1 plus R to the power N. R is the rate of interest. Compound interest, formula for compound interest, this is formula for amount, that is what amount will be getting after a period of some time, that will be calculated with this formula. And the compound interest, that is charged on that principal for that particular period, will be calculated as per the formula given here, that is P bracket 1 plus R to the power N minus 1 bracket. Okay. N is basically one second. N means number of years, and this formula is for compounding annually. Now you can have a compounding annually, half yearly, or you can say semi-annually, quarterly, or even daily. Now your formula will be changing, get changed with as your compounding method change. If it is annually, then it will be different. If it will be half yearly, it will be different. It will be quarterly, it will be different. If it is daily, it will be different. So for annually, we have seen principal into 1 plus R to the power N. Okay. Now let's say your principal is 100 rupees. R is 10%, N is 1 year. then your formula will be 100 into 1 plus 10 by 100 to the power 1. Now, half yearly. All things remaining same, n will be 1 year. Okay, let's say 1 year, but it is for compounded half yearly. We will have another I, that will be 2. That will be 2. Why it will be 2? Because if I divide a year in 2 parts, it will become 6 months, 6 months. So we'll be getting this as 2. Okay. So I will be 2. Now my formula will become 100 1 plus 10 by 2 divided by 100 to the power 1 into 2. Now, it will become 100 1 plus 5 by 100 to the power 2. So, it will become 1.05 to the power 2 and 100. Okay. Now, how to calculate this amount? We need to see our calculator. Please bring your calculator. I'm giving you 1 minute for the same. Okay, you can pause it or again play it on. I'm waiting for 1 minute. Now I will be teaching you. I hope you have brought your calculators. I'll be teaching how to calculate this. Now 1.05 is this, actually the 5%. You have seen this. So I need to increase the value of rupees 100, okay, to 5% for 2 years. So how are you going to calculate in the calculator? First, write down 100 in your calculator. One second. Write down 100 in your calculator. Then press sign plus. This one. Okay. Now, this is 5%. So write it 5 here and press percentage. Okay, percentage. Then again press plus. Okay, then write 5, then click percentage. The value I am getting here is 110.25 rupees. Now this is the amount that I am going to receive after a period of 2 years. Okay. So basically if it is for 2 years, so that's why we have done like this. If it is for 3 years, then we'll be pressing the plus button, we'll again be pressing 5 and then percentage. So that's how we're going to calculate. This is just a minute trick. Okay, I'll explain it to you once or twice more. Okay, with this thing. But right now, just understand that. If you have not, then I'm just going to explain you this again. We will note the amount first of all. We'll calculate it similarly for quarterly. Now you are going to understand in a better way. So for here, N is again 1 year, okay, and I will be 4 because there are 4 quarters in 1 year. So the formula will become like amount is equal to 100, 1 plus 10 by 4, okay, divided by 100 to the power 1 into 4. So this amount will become 100, 1 plus 2.5 by 100, that is 2.5%, and n is 4 times. Now again, let me explain you how we are going to calculate this. 100, 1 plus 1.25 to the power 4. So actually it is 2.5%. Okay. So don't make it complicated. Let me do the screen big. Okay. Write 100. Okay. Press button plus. Okay. Then press 2.5. Then press percentage. So this is for your first. Then we need to calculate for 4 quarters. So this is for quarter 1. Again press 2.5 plus, press plus, then 2.5, then percentage. This is for second year. Then again press plus, then press 2.5 and press percent. Then again plus, 2 times we have done this. This is third time we are doing 2.5, then percent. Okay. Then again plus 2.5, then percent. So this is the answer that we have got. So it will be 113.1408. So this will be your answer if it is calculated quarterly. So this is how the formula will change, and this is how you can basically understand in and calculate in a faster way by the help of calculator. So you can note it down. Okay. I hope this is clear to you. Okay. If it is not, then pause it and again watch the same. Okay. Let us practice some questions. Before this, I am giving you time to note this. let us practice some questions. First problem deals with the annual 2000 rupees is basically invested at annual rate of interest 10%, and after 2 years what will be the amount if the compounding is done. So basically we need to calculate the amount, okay, and the principal is 2000, interest is 10%, okay, and time, or you can say n is 2 years. Now we have two cases to calculate annually and to calculate semi-annually. Let us see how it will be done. Given that principal is 2000, interest 10% and 2 years. Calculate amount, calculate compound interest. So the first case is to calculate it annually. Okay. In case of annually, n will be 2 into 1, that is 2 years. Okay. So let us calculate. Amount is P into 1 plus R to the power R upon 100 to the power n. So principal is 2000, 1 plus R is 10% upon 100 to the power 2. Okay, I will just check n. Yeah, 2 years. Okay, so the same thing that we have done. Again, I am going to tell you this for 10%. Write 2000 plus 10% plus 10%. It will be 2420. Now, you can check it, the answer. It's 2420. We have done it right. Okay, congratulations. Now, next is to do it semi-annually. Okay, now the formula will be changed. Second, to learn it in a better way, semi-annually, that is half yearly. Now my n will become 2 into 2, that is 4. Okay, and my formula will become A is equal to P into 1 plus R by I upon 100 n into I. Okay. Now, this is 2000 into 1 plus what was R, 10% divided by I, that is 2, okay, divide by 100 to the power 2 into 2, that is 2000 into 1 plus 5 by 100 to the power 4. Again, I'll be telling you how we'll be going to calculate in the calculator. Now this is 5% which is coming. You have to see this, okay? So again, 2000 plus 5% plus 5%. You have to do this process 4 times, plus 5% plus 5%. The amount you are getting will be 2431.0125. Okay, let me check the answer. My answer is correct. Okay, so this is how we're going to calculate this. Now next question. Okay, just giving you time to write it. Now in the practice sheet, in downwards in my notes, we have an assignment problem. In that you can get the similar question to practice with. So after watching this lecture, first practice question with respect to these topics and then move ahead with the next topic. So we have 2 more questions to do. Please pause it and note it. Fast. Do it fast. Done? Now, next question is, a company offers an FD scheme whereby 10,000 rupees will mature to 12,625. This is the amount, this is the principal. Time is 2 years, but it is half yearly, so n will become 2 into 2, that is 4. And if the company wishes to amend scheme by compounding interest every quarter, so unko n, they need to make the n to 2 into 4, that is 8. Okay, so what will be the revised value? So right now, first of all, we need to find out the rate of interest. How are you going to find it? Principal is given 10,000. Amount is given 12,625. Okay. And n is 4. Now, okay, I'm going to discuss this in next video. Reason being, for teaching this, I need to teach you one table. Okay, right now I will just show you the face of this table. You are seeing this table, compounded value of a given amount. So basically, this is suppose your compounded value is 5%, okay, and your n is 4. So the value that we were calculating by way of calculator will come like this, 1.216. So you can see easily with this table. So I'm going to teach you how to see this table, and with the help of this table, we are going to solve the next problem. Okay. So before signing off, I'll just these 2 questions will be solved by me. Okay, I'm going to help you with this in the next video. But for you, the homework that is there is basically in the assignment area. Come to the assignment area. You can see you have some questions. Here we don't have some question, but I'll be giving some question to practice for simple interest and compound interest. So you need to solve these questions. That is the homework. That is the similar question that we have discussed in the class. So you should be able to do it on your own. Now this first question is basically for compounding only. So this is your homework. And I'll be giving some more questions on this thing. Okay. Thank you.